The great mistake in markets is to think the most important event announces itself with a trumpet. It usually does not. It usually arrives wearing a technical label, speaking in the bland language of policy operations, while the real meaning sits underneath it, like dynamite under floorboards. That is what I believe has just happened. A lot of people are staring at gold and they are asking why gold keeps behaving so powerfully, even after the Federal Reserve spent years talking tough, raising rates, promising discipline, and performing for the public, as if inflation fighting were the only religion left in Washington. They look at the speeches. I look at the balance sheet. They look at the words. I look at the arithmetic. And arithmetic has no talent for lying politely. The arithmetic says the Federal Reserve has already crossed a line that matters enormously to every person holding dollars, bonds, stocks, retirement assets, real estate, or precious metals. The line is simple. When a monetary authority spends years telling you it is withdrawing support, then quietly turns around and begins creating new money to absorb government debt, again, the argument is no longer about tone. It is about survival. That is the moment when people who understand monetary systems stop debating slogans and start thinking in hierarchy. What breaks first? What gets protected first? What gets diluted first? What cannot be printed at all? That is why gold matters here. Not because gold is magical, not because every man who buys a coin is suddenly a prophet, and certainly not because price action alone is a philosophy. Gold matters because when the managers of a paper system are cornered by debt math, refinancing pressure, and political constraints, the thing being repriced is not just a metal, it is trust. And once trust enters the equation, a great many assets begin trading on a different basis. I want to say something plainly at the beginning because people often try to turn every argument into a tribal chant. I have spent my life preferring productive assets. Give me a great business over a shiny rock every day of the week. Give me farmland over a vault. Give me cash coming in from a durable enterprise over something that just sits there and waits for somebody else to fear more tomorrow than he feared yesterday. That has always been my instinct. But instinct is not a substitute for recognizing a regime shift. If a productive asset is priced in a currency being slowly cornered by its own debt architecture, then the denominator matters. And when the denominator changes, the investor who ignores that change is not being disciplined, he is being lazy. That is what I think too many investors are doing now. They are reading this moment like a normal cycle. It is not. A normal cycle is when a central bank tightens, growth slows, inflation cools, balance sheets shrink, and credibility rises because policy and arithmetic are still cooperating. This is something else. This is a system trying to present one face to the public while its internal plumbing begins moving in another direction. That divergence is where the real story begins. I want to frame it the way I would frame any business problem. Forget the headlines for a moment. Imagine you are looking at a company and management has spent 3 years telling shareholders that costs are under control. Leverage is improving, discipline is sacred, and waste is being removed from the system. Then quietly, without fanfare, management begins borrowing again to refinance old obligations and keep the machinery from seizing up. Would you treat that as a minor footnote? Of course not. You would say the public story and the internal necessity have diverged, and once that happens, the internal necessity wins. That is what has just happened in money. Call it reserve management, call it technical liquidity support, call it responsible market functioning. I do not care what perfume they spray on the language. If new money is being created to absorb government debt and support the system's ability to roll itself forward, then the mechanism matters more than the name. A skunk in a tuxedo is still a skunk. The first mechanism you need to understand is one I would call the credibility swap. For years, the Federal Reserve tried to buy credibility with tightness, higher rates, balance sheet reduction, a posture of discipline, a theater of control. That posture had a purpose. The public had to believe that inflation was being fought with conviction. Bond markets had to believe that the central bank would not simply surrender. The dollar system required an image of command. Now the cost of maintaining that image has become too high. Why? Because the debt stack matured into the wrong interest rate world. That is the heart of it. You can make many things sound complicated in finance, but the basic trap is usually simple enough for a child to understand. If you borrowed a mountain of money when the price of money was nearly zero, and then a large chunk of that mountain has to be refinanced when the price of money is 4 or 5 times higher, your problem is not emotional. It is mathematical. The United States now sits in that problem. Debt that was comfortable when money was free becomes suffocating when it is not. And here is where most retail investors lose the thread. They think the system can simply choose austerity if it wants to. That is fantasy. A household can tighten its belt. An empire carrying trillions of rolling obligations, a $1 trillion interest bill, a politically addicted fiscal machine, and a financial system that still requires abundant liquidity does not simply wake up one morning and decide to become prudent. The system can speak prudence. It cannot live it cleanly anymore. That is a hard statement, but it is the statement the arithmetic keeps making. When interest expense starts devouring fiscal room, the state loses optionality. When refinancing needs become enormous, the buyer of last resort begins creeping back onto the stage, even if he arrives wearing different clothes. That is why I say the thing being repriced is trust. Trust in restraint. Trust in the neutrality of money. Trust that the managers can keep the machine running without leaning on the printing press again. Now, because people hear phrases like that and immediately run toward hysteria, I want to pull this back into ordered thinking. This is not an argument that tomorrow morning your dollars become wallpaper. It is not an argument that every chart will go vertical in one dramatic act. Markets do not usually move that cleanly. Systems rot in layers. Recognition comes in waves. The smart money moves first. The official sector moves next. The public arrives last. That sequence matters. And if you understand it, you can stop behaving like the last guest, stumbling into the party when the chairs are already full and the bill has already been split. The second mechanism is the one most people still fail to appreciate, and it began before this latest Federal Reserve shift. I call it the Reserve Awakening. When the United States froze Russia's foreign currency reserves, it did something much larger than punish an adversary. It taught the world a lesson. The lesson was not subtle. If your national savings can be disabled with a signature, they are not really sovereign in the deepest sense. They are conditional. They are allowed to be yours until politics says otherwise. That realization did not matter much to a retiree reading headlines over coffee. It mattered a great deal to central banks, because central banks do not think in tweets. They think in reserve architecture. Once that lesson landed, the gold market changed character. It stopped being only a retail fear trade or an inflation hobby horse and became something more serious. It became part of a sovereign insurance policy. That is why central banks have been among the most aggressive and disciplined buyers of gold over the last several years. They were not chasing momentum. They were not reacting to message boards. They were reading the architecture. And once you see that, you understand that phase one of this move in gold was never designed to look theatrical. It was designed to look almost boring. A methodical reallocation, calm accumulation, institutional repositioning before the crowd understood the direction. That is how intelligent capital behaves. It does not wait for commentators to agree on a catchy label. It reads the incentive structure and moves before doing so, becomes emotionally comfortable. This matters because a lot of people are waiting for a giant visible breakdown in the system before they are willing to believe anything has changed. They want sirens. They want a historic bank run on live television. They want governors sweating under lights and using emergency language. That is not how the earliest and most profitable stage works. The earliest stage is almost always hidden inside technical operations and policy euphemisms. That is why the quiet move often matters more than the noisy one. The noisy one is for the public. The quiet one is for people who know how to read the balance sheet. Now let us move into the third mechanism, because this is where gold stops being an abstract macro discussion and starts becoming a mirror held up to the dollar system itself. I call it the forced buyer problem. The Federal Reserve is most powerful when markets believe it has room to choose. The moment the market begins to suspect that the Fed is not choosing but being compelled, the nature of the game changes. That distinction is everything. A central bank that chooses to stimulate can later choose to restrain. A central bank that is forced to buy debt because the alternative is disorder in the treasury market is no longer operating from strength. It is operating from necessity. And necessity is what markets smell before the public does. There is a dangerous fairy tale in finance. The fairy tale says policymakers will do the disciplined thing because they know what the disciplined thing is. Nonsense. Knowing and being able are different animals. A man drowning may understand the virtues of calm breathing, but that does not mean he can negotiate with the water. When debt maturities pile up, interest costs surge, private demand for bonds softens, foreign appetite cools, and the system still requires liquidity. The Federal Reserve is not standing in a room with 5 elegant options. It is standing in a room with 1 ugly option and 4 uglier ones. That is the real choice set. Investors who fail to understand that keep assuming the institution retains the kind of sovereignty over events that it used to have. It does not. Its room to maneuver has narrowed dramatically. That narrowing is bullish for gold because gold does not need a speechwriter. Gold does not need credibility. Gold does not need to issue guidance. Gold simply sits outside the promise structure. And when the promise structure begins to wobble, the value of what sits outside it rises. Not in a straight line. Not politely. But eventually and often violently. Now a sensible person would ask the next question. If the Federal Reserve is shifting quietly, why has the full public move not happened yet? Because the market moves in layers. That is the 4th mechanism, call it the staggered recognition curve. In every major repricing event, the first buyers are those closest to the plumbing. The second buyers are those closest to the institutional incentives. The third buyers are those closest to fear. By the time the third group arrives, the easy money is gone. Central banks were early because they were forced to think early. They are paid to think about reserve vulnerability, sanctions, counterparty risk, and monetary hierarchy before television segments start using fashionable graphics. They saw the problem, they moved. Now the market is entering a more sensitive stage because once the Federal Reserve begins supporting debt markets again, while the fiscal picture remains stretched and the energy picture grows more unstable, the story graduates from quiet repositioning to live monetary contradiction. That contradiction is very hard to contain indefinitely. You cannot tell the world you are shrinking the monetary footprint while quietly growing it. You cannot preach scarcity while manufacturing liquidity. You cannot ask the public to believe that paper remains absolutely neutral, while the official sector around the world is quietly diversifying away from dependence on it. Eventually, the contradictions converge. That is when phase 2 begins. I want to describe the phases not as a pundit's parlor game, but as an operating framework. Because unless an idea can be translated into a framework, it is just entertainment with a necktie. Phase 1 is what I would call the quiet migration. This is the period when the institutional world sees the fire risk before the smoke becomes obvious to everyone else. Central banks accumulate, smart allocators reposition, gold rises, but its rise still looks deniable to people who want denial. The public can still explain it away with a half-dozen shallow theories: rates, fear, charts, momentum, social media, whatever helps them avoid the deeper conclusion. That phase has already happened. We are living with the consequences of it. Phase 2 is what I would call the credibility fracture. This is when the market realizes the Federal Reserve is not merely adjusting policy but running into structural compulsion. That does not require hyperinflation. It does not require immediate catastrophe. It merely requires enough participants to understand that the institution is trapped between defending the currency's story and defending the system's survival. Once markets believe survival comes first, gold stops being a quirky hedge and starts becoming a judgment on policy reality. That is when moves can accelerate dramatically. Not because everyone suddenly becomes a gold fanatic, but because enough people decide they cannot afford to be indifferent. Phase 3 is the one nobody likes to discuss soberly because it sounds too frightening to the polite set and too irresistible to the apocalyptic set. I have no interest in either camp. The phase matters because it is possible, not because hysteria is useful. Call phase 3 the bond. Market spiral, here is the plain version. Persistent inflation or elevated rates keep interest costs high. High interest costs force more issuance. More issuance needs more buyers. If the market's natural buyers are insufficient or unwilling, yields rise. Rising yields raise future interest costs again. The loop feeds itself. At some stage, the central bank is no longer loosely influencing the market. It is backstopping it. That is the point at which money creation ceases to look like a temporary tool and starts looking like the system's only politically survivable answer. When nations enter that zone, gold does not rise because it is pretty. It rises because paper is being asked to carry too much disbelief. Now, I want to bring in the oil layer because this is the accelerant that can shorten time frames dramatically. There are many monetary stories that could have unfolded over several years in a slow, miserable grind. Oil shocks do not like slow grinds. They like compression. Energy is embedded in everything. Transport, manufacturing, food, chemicals, utilities, confidence. When oil jumps sharply and stays elevated, inflation is not merely a statistic. It becomes sticky, physical, and politically irritating. The central bank then faces a deeper dilemma. Fight the inflation aggressively, and you stress growth, financing conditions, and the debt stack even harder. Accommodate the system, and you validate the inflation psychology and weaken the monetary story. That is why oil has historically been such a brutal companion to monetary transitions. It takes what might have been a slow policy contradiction and turns it into a faster public recognition event. That is what makes the current setup so dangerous and so explosive at the same time. You have a debt problem, you have a credibility problem, you have a reserve realignment trend. And then, layered on top, you have an energy shock moving through the same system. These are not three separate stories. They are three gears in the same machine. And when they begin turning together, the investor who understands the mechanism behaves very differently from the investor who is merely reacting to headlines. The mechanism reader says, the denominator is under pressure. The official sector is already moving, the central bank is quietly confirming the direction, and the energy shock can speed recognition. The headline reader says, gold is up a lot, maybe I missed it, maybe it is a bubble, maybe I will wait until things are clearer. Clarity in markets is usually offered at a premium. That is one of the great jokes the world plays on people. Certainty comes late and expensive. Now let me say something that most people need to hear, because greed is always waiting behind conviction like a pickpocket behind a tourist. A good macro thesis is not permission to behave stupidly. A lot of investors hear a story like this and immediately want the most dramatic vehicle they can find. They do not want a framework. They want a weapon. They want leverage. They want the thrilling version. That is how people take a correct big picture and turn it into a personal disaster. You must distinguish between being directionally right and structurally safe. If your capital structure cannot survive the path, then the path will destroy you before the destination arrives. That is as true in gold as it is in stocks, real estate, or anything else. There is no prize for dying correctly. That is why the fifth mechanism matters so much. I call it path supremacy. The path beats the thesis for anyone who is overextended, emotionally unstable, or dependent on timing precision. You may be entirely right that the monetary denominator is weakening and gold will be repriced much higher over time. Wonderful. If you borrow too much, buy too late, panic on the first downdraft, or allocate capital you cannot leave alone, the path will humble you anyway. The market does not care whether your macro essay was intelligent. It cares whether you can remain the owner long enough to benefit. That is why the first rule in any environment like this is not courage. It is durability. Now, let us discuss silver, because people always do one of two foolish things with silver. Either they dismiss it as gold's noisy cousin, or they treat it like a lottery ticket disguised as a metal. Silver deserves more respect than the first group gives it and more discipline than the second group has ever heard of. Historically, silver has often lagged early and then moved harder later. Why? Because silver sits in an odd place between monetary psychology and industrial demand. When a precious metals move matures and the public starts arriving, silver often begins compressing years of neglect into a much sharper repricing that does not make it superior in all circumstances. It makes it more temperamental. In a later stage precious metals bull, that temperament can become very powerful. In a confused or premature phase, it can become painful. An adult understands that difference. A child just wants velocity. Now let me talk about the area most people are still ignoring entirely, gold miners. If you want one of the most extraordinary illustrations of how slowly public attention reacts, look at mining equities. When the gold price rises from levels that barely covered costs into levels that produce very large margins, the business economics of miners can change dramatically. Revenue rises, margins expand faster than revenue. Free cash flow can explode. And yet the crowd often remains absent because it is still worshiping whatever growth idol was fashionable. 6 months earlier, that sort of disconnect is extremely important. In markets, the best asymmetries often appear when economics improve much faster than narrative attention. The crowd is usually a late student. It needs magazine covers, it needs easy stories, it needs somebody else's profits to become visible before it feels emotionally safe. By then, the institutions that bothered to do the arithmetic are already sitting in the good seats. That is what can happen in miners. Now, I am not speaking carelessly here. Mining businesses carry operational risks. Gold itself does not. Mines flood, management teams disappoint, politics interferes, Jurisdictions change, costs move. This is not a nursery. But the setup matters. If the underlying metal is repriced higher while the market still treats the producers like a sideshow, you can get a very large eventual reconciliation. Again, not because the world is fair, because arithmetic catches up with neglect. That is the opportunity. Smart capital is always hunting, not popularity. Delayed recognition. The sixth mechanism is what I would call the denominator illusion. Most investors think they are judging assets. In reality, much of the time they are judging denominators without realizing it. A stock can rise because the business is better. A house can rise because the land is scarcer. Gold can rise because trust in paper is eroding. But when the denominator itself becomes unstable, all the comparisons become muddy. That is why people get confused in monetary transitions. They ask whether gold is expensive, whether stocks are expensive, whether houses are expensive. Sometimes the better question is whether the measuring stick is being shaved thinner. If the measuring stick is being quietly compromised, then what looks expensive may simply be honest. That is a very difficult idea for people trained in ordinary cycles to accept. They want clean labels, cheap, expensive bubble value. But once the denominator enters the story, the old labels stop working so neatly. Then the investor has to think in systems rather than slogans. That is the adult version of investing. Now, because I do not want to leave this floating in the sky, let me tell you how I would think about operating inside this kind of environment. First, I would separate narrative conviction from tactical aggression. I might become more convinced that the regime is shifting without becoming reckless in how I express that conviction. That distinction matters. A great many people lose fortunes, not because they were wrong in kind, but because they were impatient in degree. Second, I would build any exposure with the assumption that volatility is not a bug here. It is the toll booth. If you expect a smooth trip through a monetary transition, you are asking to be mugged by your own emotions. Third, I would avoid treating the first public recognition wave as the final one. When systems shift, repricings often come in stair steps. A quiet phase, a recognition phase, a panic phase, a public phase, a broad ownership phase. The first fast move does not always mean the thesis is fully owned. Sometimes it merely means it has begun graduating out of the basement. Fourth, I would remember that productive assets still matter enormously. This is not a sermon against business ownership. Quite the opposite. In a world where the denominator is pressured, owning scarce productive assets with pricing power becomes even more valuable. The trick is not to choose between monetary hedges and productive assets, as if you were selecting one child to keep. The trick is to understand what role each asset plays when paper is under strain. Gold protects against the failure of promises. Great businesses protect against the long erosion of purchasing power if they can raise prices, defend margins, and endure the regime. Energy can benefit from the shock itself. Utilities can steady a trembling ship. Defense firms can live on the state's priorities. You build a hierarchy of resilience. That is what thoughtful capital does. Now let me speak plainly about human nature, because the real battlefield is never just economic, it is temperamental. When markets move into a new regime, most people continue behaving as if the old regime still rules. That delay is expensive. People anchor to what worked yesterday. They trust the institutions that trained them. They repeat comforting phrases about normalization, discipline, soft landings, and policy credibility. Meanwhile, the insiders closest to the arithmetic are already repositioning. Why do ordinary investors keep arriving late? Because they want emotional permission. They want the world to bless their decision. They want the authorities to agree. They want the newspapers to approve. They want the move to already feel normal before they participate. That instinct is understandable. It is also ruinous. The greatest opportunities rarely come dressed as consensus. They come dressed as discomfort. That is why central banks buying gold over several years mattered so much. They were not asking for applause. They were not waiting for the public to agree. They were acting on an incentive change before it became a social fact. The public still thinks that is optional. It is not optional. It is the whole game. You either learn to read incentive changes early, or you spend your life paying higher prices for clarity. Now let us return to the Federal Reserve one more time, because this is the nerve center. The public will be told 1,000 stories to soften what has happened. Technical adjustment, liquidity support, normal market function, temporary response, operational necessity. Every bureaucracy invents gentle words for hard realities. That does not upset me. What upsets me is when investors allow gentle words to replace hard analysis. If new money is being created to support debt absorption in a system drowning in refinancing needs, then the direction matters more than the press release. The Federal Reserve may still want lower inflation. It may still want respect. It may still want a smaller balance sheet in some ideal world. But markets are not run in ideal worlds. They are run in constrained worlds. Once the constraint tightens enough, ideals become decorations. Necessity becomes policy. That is what I mean when I say Phase 2 begins, when the market realizes the Fed is no longer the author of the script, but one of the actors trapped inside it. That is when gold can move from a specialist's hedge to a wider public necessity. And once the public begins to understand that money itself is being managed as a political survival tool rather than as a stable yardstick, the repricing can become much larger than people now imagine. Again, not in one breath, but in a sequence. That is the important thing. People love dramatic endings. Real markets prefer sequences. A small technical shift, a quiet accumulation wave, a policy contradiction, an energy shock, a public recognition event, a broader rush toward things outside the promised structure. That is how these transitions usually travel, step by step. Then all at once, in the minds of people who were not paying attention. I also want to say something that might disappoint the zealots. Gold will not save a foolish man from himself. Neither will silver. Neither will miners. Neither will a wonderful business. If you are chronically emotional, chronically overleveraged, or chronically desperate to get rich on a schedule, you will find a way to misuse every good idea that comes near you. That is why the real operating system is internal. Patience, scale, discipline, liquidity. A refusal to let the calendar bully you. A refusal to buy only when the world finally agrees with you. A refusal to treat volatility as disproof. These are not glamorous qualities. They are profitable ones. Now let me pull all of this into the simple sentence that matters. The Fed's quiet turn toward debt absorption is not just a technical monetary event. It is a public clue that the paper system has entered a narrower corridor. That corridor raises the strategic value of assets that sit outside direct political manufacture and increases the importance of owning productive assets, capable of surviving a weaker denominator. Gold is the purest symbolic expression of that change. Silver is a later and more volatile expression. Mining stocks are a leveraged economic expression if selected with care, and high-quality productive businesses remain essential if they possess real pricing power and real durability. That is the complete picture as I see it. Not fear, not worship, hierarchy. The hierarchy of what survives best when a system that issues the measuring stick begins quietly admitting it cannot keep pretending the measuring stick is untouched. That is what this is really about. Not a medal, not a headline, not a rumor, a measuring stick under pressure. The final choice is not whether you enjoy dramatic narratives. The final choice is whether you are willing to see what the arithmetic is already saying. You can tell yourself the old story. You can tell yourself that policy will somehow become painless. Debt will somehow refinance itself gracefully. Interest expense will somehow stay manageable. Energy shocks will somehow pass without consequence. And central banks all over the world were somehow buying gold in size for no serious reason. You can tell yourself that. Many people will, they always do. Or you can accept the harder truth when the stewards of paper begin quietly behaving in ways that reveal constraint. The wise investor stops treating gold as a curiosity and starts treating the whole portfolio as something priced in a more fragile denominator than it once was. Once you see that, you stop asking childish questions like whether the move has already gone too far. You start asking adult questions. What phase are we in? What is being repriced? Which assets sit outside the promise structure? Which businesses can survive the denominator shift? How much liquidity do I need to remain patient? How do I avoid becoming a forced seller while others are panicking? Those are the right questions. And the people asking the right questions in a regime change almost always end up miles ahead of the people waiting for the evening news to make it emotionally comfortable. That is the contract this moment offers. Not certainty, not comfort. Clarity bought at the price of discomfort. That is usually where the best investments begin. And if you cannot pay that price, the market will make you pay a higher one later.